Investors face numerous challenges when managing their portfolios, regardless of size or diversification. Below is a detailed analysis of key weaknesses that can undermine investment strategies, illustrating how these vulnerabilities may impact performance and long-term goals. 1. Overconcentration in a sector or geography. A common risk is overconcentration in a specific sector or geographic region. For example, focusing too heavily on technology companies exposes the portfolio to sector-specific downturns. Similarly, a geographic bias toward a single market, such as the US or China, makes investments vulnerable to localized economic, political, or regulatory risks, undermining diversification efforts. 2. Liquidity constraints. Some investments, such as real estate or private equity, require long holding periods and lack liquidity. This can become problematic during periods of financial stress, when investors need to access cash quickly. The inability to sell such assets without incurring losses can limit flexibility and exacerbate financial strain during market downturns. 3. Dependence on market timing. Relying on market timing is fraught with risks. Predicting market movements is challenging, and mistimed decisions can lead to missed opportunities or unnecessary losses. Emotional decision-making, driven by fear during market dips or greed during rallies, often exacerbates these mistakes, leading to underperformance. 4. Economic cycles and correlations. Market performance often aligns with broader economic cycles. During crises, asset classes previously considered uncorrelated may exhibit heightened correlations, diminishing the benefits of diversification. For instance, stocks, bonds, and real estate may all decline simultaneously in a systemic downturn, leaving few safe havens. 5. Over-reliance on historical performance. Investors frequently base decisions on past performance, assuming that historical trends will persist. This mindset can be detrimental in dynamic markets, influenced by technological innovation, regulatory changes, or shifting consumer preferences. Investments that once excelled may falter under changing circumstances. 6. Management risk in individual investments. Investing in individual companies entails risks tied to corporate governance and decision-making. Poor leadership decisions, unethical practices, or operational mismanagement can significantly harm a company's value. High-profile corporate scandals serve as reminders of how quickly mismanagement can erode investor wealth. 7. Undervaluation of emerging markets. Investors often overlook emerging markets due to perceived risks, such as political instability or currency fluctuations. While these markets do carry unique challenges, neglecting them entirely can result in missed opportunities for high growth. A balanced approach is necessary to capitalize on their potential while managing risks. 8. Inflationary pressures. Inflation can erode purchasing power and real returns, particularly for fixed-income investments like bonds. Companies unable to pass rising costs onto consumers may also struggle, affecting equity investments. Inflation-hedged assets are essential to maintaining portfolio value in such environments. 9. Over-diversification. While diversification reduces risk, over-diversification can dilute returns. Spreading investments too thinly across many unrelated or underperforming assets may result in a portfolio that fails to capitalize on strong performers. Managing too many investments can also increase costs and complexity. 10. Regulatory and legal risks. Changes in regulations or legal challenges can impact investments significantly. For instance, stricter environmental policies might hurt traditional energy companies, while antitrust actions could challenge dominant technology firms. Keeping abreast of regulatory trends is vital to managing such risks. 11. Currency fluctuations. International investments are exposed to currency risk, where exchange rate fluctuations can affect returns. A strong domestic currency can reduce the value of foreign earnings when converted, eroding gains. Hedging strategies are necessary to mitigate these effects, but can be costly and complex. 12. Environmental, social, and governance. ESG risks. Investors increasingly prioritize ESG considerations, but failing to account for these factors can lead to losses. Companies with poor sustainability records or governance practices face reputational damage and financial penalties, reducing their appeal and valuation. 13. Technological disruption. Technological innovation can disrupt traditional industries and render certain investments obsolete. For example, renewable energy advances may challenge fossil fuel companies, while e-commerce continues to disrupt brick-and-mortar retailers. Ignoring these trends can lead to underperforming investments. 14. Global geopolitical risks. Geopolitical events, such as trade wars or military conflicts, create market volatility and uncertainty. Investments linked to affected regions or industries may experience sharp declines, requiring careful diversification to manage these risks effectively. 15. Interest rate sensitivity. Interest rate changes influence various asset classes. Rising rates can hurt bond prices and high dividend stocks, while falling rates might inflate bubbles in sectors like real estate. A balanced portfolio needs to withstand both scenarios to maintain stability. 16. Tax implications. Tax considerations, such as capital gains taxes or international tax treaties, can reduce net returns. Without proper tax-efficient strategies, such as leveraging tax-advantaged accounts, investors may inadvertently sacrifice significant portions of their gains. 17. Psychological biases. Behavioral biases, including overconfidence, herding, and loss aversion, often lead to poor decision-making. For instance, investors may sell winners too early out of fear or hold on to losing positions too long, hoping for recovery. Recognizing and mitigating these biases is crucial for effective portfolio management. 18. Neglect of alternative investments. Traditional portfolios often overlook alternative assets like commodities, hedge funds, or cryptocurrencies. While these options come with higher risk, they can provide non-correlated returns and serve as valuable hedges against market downturns. Ignoring them entirely limits diversification opportunities. 19. Dependence on dividends. Portfolios relying heavily on high dividend stocks face risks when companies cut or eliminate dividends, particularly during economic slowdowns. Additionally, dividend stocks may lose appeal in rising interest rate environments as fixed income securities become more attractive. 20. Lack of rebalancing. Failing to regularly rebalance a portfolio can result in unintended overexposure to specific assets or sectors due to market fluctuations. This misalignment increases risk and may reduce overall returns. Regular rebalancing ensures that investments remain aligned with an investor's goals and risk tolerance. Conclusion: managing a portfolio effectively requires addressing these weaknesses through strategic planning, diversification, and regular review. By understanding and mitigating these risks, investors can enhance resilience, capitalize on opportunities, and achieve sustainable long-term growth.